Welcome to the Supported Living Property Podcast with your host, me, Lisa Brown, the place to learn about supported living property investing. Hi, Usman. It's great to have you here today. Thank you for joining us. How are you?
Very good. How are you, Lisa?
Yeah, no, I'm good. The sun's shining. It feels lovely. And I feel finally well after COVID. So that's good. I felt it.
Yeah. It's been like the pollen bomb that's affecting everyone right now because it's just crazy with the weather and stuff. Yeah, absolutely.
Yeah, it's bonkers, isn't it? But yeah, no, I finally feel like I've got a bit of energy today. So that's really good. It's cool. For people who don't know you, Usman, and I think a lot of people will have heard you speak at places, you talk about this subject. It's something obviously that you're brilliant at. But would you just introduce yourself and tell people a little bit about you?
Okay, so hi everyone, my name is Usman Nazir. I'm one of the directors of James Nazir Co, and we specialize predominantly in capital allowances and fixed asset analysis. Now, I'll be going through the ins and outs of capital allowances with Lisa in more detail, but just to give everyone a general kind of overview of what it is that we do. Capital allowances is a form of property tax relief that's available for everyone who owns a commercial property. So in this specific example, we'll be talking about how it applies to supported living. But in general terms, what we claim capital allowances on is all of the integral features and plant machinery embedded within any type of commercial property. So, and it's all the same. I mean, we're looking at all of kind of the ironmongery, the flooring, the heating, the ventilation, all the wiring, all the switchgear, all the lighting, kitchenware, sanitary ware, all that kind of stuff. And it's the same to varying degrees across every single property. I'm going to
stop you there because I know that I would immediately be going, oh my God, this sounds really boring. This isn't relevant to me. Why do I need to know about this? And then because you live in it and you're so passionate about it and you understand it so well, I can hear myself thinking, oh my gosh, this is just too complicated. I don't want to know about it. But just to kind of intersect kind of before you carry on a bit more, Usman, is just to really stress to people, this is something that's really worth understanding. It can really make a big difference to your business and has really big implications. So do really listen into what Usman's saying here. And Usman is also very well known for speaking really fast because he's got so much great knowledge on stuff. So we were just saying whether there was like a half speed setting we could put on podcast. But
yeah, of course, yeah.
but so capital allowances are something that we all need to think about if we're in the property space, would you say?
Yes, absolutely. Because what it does is not only does it add value to any type of commercial property venture that you're doing, all those items that I just mentioned, you can claim back that value back as tax relief on any type of commercial property that you acquire. And that's what capital allowances is all about. So if we're identifying all that and just deriving it from the purchase price or expenditure that you've incurred in it to wipe out your tax bill for the first couple of years, then it makes that transaction, that acquisition of that commercial property that much more viable because it might be the difference between the numbers stacking up. I mean, if you're able to retain all of your income for the first couple of years, then it's massive. Literally, if you're entitled to claim it and you're not claiming it, you're insane because why would you pay that? Because invariably, we always have a joke, me and my business partner Matthew, where whenever I don't pick up a client on day one, when I meet them, I'll invariably pick them up on the day where their tax return is due because it's a case of, right, would you rather just pay 20 grand in tax or a small fraction of that to us to wipe and mitigate the whole thing? And the numbers just stack up. And that's what this is all about. It's just about adding value, allowing you to claim what you're entitled to and making your business that much more viable by retaining your money, helping you to invest it back into the business and do whatever it is you want to do with it and just expand your portfolio ultimately.
And this is only relevant to commercial buildings.
It is. I mean, so you've got the kind of residential element. I mean, if it's a commercial block of apartments, there's a commercial kind of, the communal parts that we can claim on. But generally, it's just commercial property. So our bread and butter is hotels, warehouses, offices, care homes, things of that nature, restaurants, and et cetera, et cetera. So anything commercial in that respect. And the only difference is how heavily, plant machineryed up those properties are. So, I mean, a warehouse won't have much in it, but an office and a hotel will be very heavily fitted out with all those types of integral features throughout. And that impacts the amount of allowances that we identify depending on the type of property.
But it's also relevant in supported living. And that's obviously why we're talking today, isn't it? So what are the sort of, is the right term qualifying criteria? Is that the right thing? That what is it that needs to be in place for you to be able to claim capital allowances?
So for this is where it kind of gets quite tricky with supported living. So before, it was quite straightforward with regards to how we used to claim supported living. It just used to be a care facility. So anything whereby you're providing more than a normal kind of AST scenario, there's some kind of element of care, there's some support available, and the people that are living in the property are generally, vulnerable or have some kind of, disability, wherever it might be, some kind of issue. But now HMRC have made a kind of statement with regards to what qualifies for supported living. And it goes into the detail of the typical kind of caretaker scenario doesn't qualify anymore. So if you just had a vulnerable person living in the property and there was someone who's available to them, that isn't enough. If they're providing them with medicines, again, they've said that that's not enough either, and nor providing them with meals, nor is that enough. So it literally there has to be some element of support, hence the word supported living. There has to be some element of support that is available to these guys that they're able to take up. So, for example, there's a block of apartments I did recently in Milton Keynes, and this guy has it's a varying nature of kind of tenants in this property that are housed by the council. Now, we've got victims of domestic abuse, we've got victims of just alcohol and drugs kind of issues and all that kind of stuff, and and young children who are runaways, etc., etc. Now, there is support available for all these guys because you've got people who need mental health kind of assessments and they need support with day-to-day activities. So there's that kind of support available to them. There was an equine therapy kind of element where some girl used to go for that therapy every single week. There was someone else who had major kind of physiological issues because of the abuse that they'd taken at the hands of a previous partner or something, and they were having physical kind of therapy from some kind of support worker. So that kind of stuff is available to those tenants, and that's what qualifies that for supported living, because there is genuine kind of care involved with these tenants. So as long as that stuff is available, I mean, not every tenant needs to be taking that up, but as long as the services are provided and there is a genuine level of support available, that qualifies it as supported living, and then you're entitled to claim capital allowances.
So it doesn't have to be on-site care 24 hours a day. It has to be able to access that, but it has to be high-level care rather than just low-level support stuff.
On-site care makes it that much easier because then it's genuine. There's someone on site the whole time. Yeah. At least for a generally large portion of the day. Like if there's someone on site for a couple of hours a day, then it's managed and there's definitely that support in place. But if there isn't, there is support available, and it is a significant level of support, and that's what makes it support living. So it's not enough to, I mean, before we used to do claims for asylum seekers living in properties because I used to qualify under kind of assisted living thing, but it doesn't anymore because essentially they're just kind of left to it. Yeah, they get some kind of care in terms of helping them with their bank accounts and post office duties and, you know, cash withdrawals and their benefits and so on. But it's not enough. Now they've kind of just said that it has to be a certain level of care, and asylum seekers don't qualify for that. There's nothing that they need overly, you know. I think it was more a case of the fine line was people living independently with a bit of assistance. That doesn't wash anymore. It has to be a bit more skin in the game with regards to claiming capital allowances. If you want to claim capital allowances for supported living, those kind of strategies with regards to supported living are absolutely fine. But we're purely talking about capital allowances purposes here.
Right. Okay. So it's quite a significant change then, isn't it, for some people? You know, that's going to make a big difference to people. So could you claim this if you had a residential property? So say, example, a bungalow with two people with quite high support needs who've got 24-hour support there. Maybe there's quite a lot of hoisting and inbuilt adapted equipment, you know, adapted bathrooms and things like that. Would you be able to claim that, although it's a residential property, but there's a lease on the building? Is that the sort of thing that you could also claim capital allowances?
That's perfect. I mean, in terms of claiming capital allowances, that's the perfect case scenario, purely because you bought a residential property into commercial use by running it as supported living. So the fact that it's a residential property originally and you've bought it into that use, there's no restrictions to claiming. There's no way anyone could have made a claim previously. There's literally no diligence to be done except for clarifying how much you spent on the property and what we can claim back for you. So that is the perfect scenario. And that's what we're seeing a lot of people converting residential properties, but there is more large scale developments where people are converting big old commercial properties into supported living and large blocks and so on. But the residential element, absolutely fine, perfect, spot on example, and the perfect scenario for us to claim capital allowances on. And it's generally a very high claim as well. We're looking at about 40% of the purchase price, which is quite decent. That's typically what we find with offices. So yeah, definitely. And then in addition to that, there'll be any refurbishment costs that you incur doing the property up, getting it up to spec for the tenants who have those special needs, so that we can claim that additional expenditure in addition to the original purchase price. So that property, you would have bought it as a normal residential property, didn't qualify because there's nothing in it, but it's pre-trading expenditure to the business of supported living, and that's how we would claim on the original purchase price, and everything as it was in its original condition, which is massive because it just makes the allowances that we identify for you that much higher and that viable for you to obviously earn as many years tax-free income.
Fantastic. Yeah, and that really good incentive for people to do these kind of properties, which is, you know, we need more and more of them. So the building doesn't need to change classification from being it can just stay as residential. It's just it becomes commercial because of the use of the building. We
just need to confirm that commercial activity and the commercial trade, and we've got that.
Yeah. Okay, that's really interesting. From, definitely it's, and I think one of the other things that people listening, we've obviously got a lot of care providers who listen, who is if they're leasing a property, is there any way they can claim capital allowances on a property, or is it just the landlord and the property owner who can claim those capital allowances?
The capital allowances is purely just about the expenditure that someone's incurred, and we're claiming capital allowances relief against that expenditure. So if the care provider doesn't own the property, but they've spent £50,000 to £100,000 doing it up, getting it ready, then they're entitled to claim on that 50 to 100K that they've spent, because it's all about the expenditure. The property might belong to a landlord and someone else, but it's whoever spent the money. Now, potentially the landlord could claim because there's supported living going on in their property, and we could look at that from a separate point, because it's like a rent-to-rent kind of scenario. With service accommodation, and I think it would work very much the same way. I don't see why not. But the only issue comes there is the landlord. Have they got any skin in the game? Are they actually doing anything, or have they leased the job out to the supported living provider? That's where the kind of question marks come, and that's where the diligence needs to go in, and we need to establish who's entitled to claim and whether it is a viable claim in that regard. But in answer to your question, no, absolutely. The care providers, any money that they incur doing the property up, we can absolutely claim on that. But the property itself, no, because they don't own the property. So.
Mm-hmm. Okay, that's interesting. So yeah, because quite often providers will do adaptations themselves, won't they? They'll lease the building and then put in some hoisting or put something in that's required. So I think that'll probably be of interest. And if they're not-for-profit organisations, CICs and charities, they can still claim the capital allowances back, can they? Or is that a different situation?
Charity essentially is tax exempt because they don't pay tax or anything. So there'll be grants and funds involved with regards to the running of them. So then no, there wouldn't be any capital allowances available because there'd be no tax bill to mitigate to who exactly. It's in that scenario maybe whereby the landlord might be entitled to claim, because that's the only person there who's actually paying tax on the income they're getting as rental from the charity. So that scenario, yeah, absolutely. The landlord, that's where they come into play, and they might be entitled to some kind of a claim. But again, there'd have to be some kind of a management agreement in place to show that obviously they are involved in it and they're not just leasing the property to the charity and that's it. But yeah, charities, like local authority associations, they're all tax exempt. So unfortunately, those guys don't have any look in with regards to capital allowances.
Right. Okay, that's useful.
If you're buying a property from any of those authorities, perfect, because they're not entitled to claim, which means again you're completely unrestricted on making a claim because they could never claim. So you're the first person entitled to claim.
Okay, perfect. So that's helpful if people are buying properties from not-for-profit organisations, really useful. And when in this process should people get in touch with you, Usman? Should it be, when in buying a property, should people be approaching you for advice about this?
So I would say as soon as possible. Ultimately, we want to get in and retain your right to claim before you complete on the property, because what we don't want to do is miss anything. There's loads of clauses that we need to put in just to make sure that you're entitled to claim. The rules have changed whereby you need to get permission from the prior owners to be entitled to claim, and we want to secure all of that before you complete, because once you're done, then they're not under any obligation to assist us. So it's always good to get in beforehand. But with regards to actually making the claim, I would always say I'd let someone crack on. I would do that diligence beforehand to retain their right to claim, but then just leave them to it, because our main thing here is wiping out your tax bill and allowing you to keep your money, and then we would leave you to it to get it up and running and earn as much as possible. And once we know that it's profitable and it's working and the strategy is working for you, then we would come in and we would do a claim in a methodical manner whereby it makes sense. And it also works with the cash flow, because you're going to be fairly drastic when you just bought the property and you don't want to be paying my fees straight away either. So it works in terms of that. And then, 6 to 9 months down the line, we'll know if it's working or not and if this strategy is for you. What we don't do is do a claim on day one and then find, it's too much hassle, this and the other, because we know that there are people who just jump into property strategies and don't really think it through. So there's always that air of caution either which way. And it works, because ultimately we're just looking out for you as much as we're looking out for ourselves,
And certainly that was the experience that I had in buying a building. I know we spoke about it, and I'd already bought the building and I missed out. I was buying it from a vendor who was not going to cooperate at all. And I missed out on really quite a significant amount of capital allowances on that building because of that experience. So, it was a good learning lesson for me there.
It was a learning lesson. However, that wasn't, you did everything right. You got in touch. We did everything beforehand. We tried to resolve it. But sometimes, again, like we say, the vendor is not, there's no mandatory requirement for them to assist us. So if they're not going to help at the beginning, they're sure as hell aren't going to help us after you bought the property either.
No.
Had was then, and this guy was he was staunch. He wasn't having it at all.
No, he wasn't having any of it at all. But yeah, so it definitely, if you're listening and you're looking at buying buildings, then definitely look at reaching out and looking at this early on so you can get that covered off. If you can get them to cooperate, it's worth it. Have you got some examples of kind of the sort of numbers we're talking about here? I think people will be interested in.
I have a slide if I'm able to share.
Yeah, or let me just make you share. So obviously on the podcast, people won't see this, but when they're looking at it on YouTube. The slides will be there if you want to have a look. That you should be able to share now. Usman, is that working?
Let me down. Hang on, where do I go to share screen?
Just at the bottom in the middle, you've got like a green arrow.
There is. Yep, got it. So I'm going to share.
It's always easier for people to see, isn't it? Yeah.
Yep. So this is an example that we did in Worthing for a client of yours, actually. I think it was someone that you introduced me to. She had a property portfolio in Brighton. And this property is typical of what she had. Now, she picked up fairly inexpensive properties, but spent quite a bit doing the properties up, and they're all kitted out. I mean, this property alone, it doesn't look huge, but it goes back for days. And there's like about 8 rooms in this place, and like the attic, the basement, everything is fully loaded. And on this one, we got really good results. I mean, typically, as I said, about 40% is what we're hovering around based on the purchase price. But we came out with like over £250,000 worth of allowances just based on her 400k almost purchase price. So it's massive. But that was just because obviously she'd kitted the property out. So that's a combination of the purchase price and some of the refurbs that she's done. But yeah, it was a really, really high-end claim. I mean, there's a few factors that we take into account when we do our capital allowances claim. Purely the land value, we need to take that into account. So if you buy a property in Brighton and then you buy a property in London, the land values, massively different in regards to that. So that has an impact, and we have to exclude that. But with this, it was an excellent result. But this gives you a prime example of the amount of allowances and the amount of value that's potentially available from claiming these allowances. I mean, so £256,000 worth of allowances at 40%, which is what she was. Her actual relief on that was just over £100,000. So, I mean, that's £100,000 worth of tax mitigated. We keep her tax-free for the foreseeable. And that was just on one of her properties, and we did a whole portfolio. So we've kept her tax-free for the foreseeable. So this was an excellent example. I use this one purely just to show the value of, even it surprised even me that we got it as high as it was, but you don't know until you get there and what you're going to find inside the property, what it's actually going to be. But this is typical, just the normal kind of semi-detached or detached property that people buy as residential and then convert for supported living use, depending on who the provider is. This was one that we did recently. This was a purpose-built supported living block of apartments for, I think it was young, vulnerable teens or something along the lines of that. Now, he built this at a cost of 1.2 million. So this particular client had a parade of like arcades and so on, and he sold all of them just to fund this kind of development. Built it from scratch. 1.2 million, and it had everything. I mean, the smoke extraction systems. It had like a water attenuation system, which I've never seen before, whereby because it was kind of like in a valley, the way he built it, there was lots of water that used to kind of build up, and the drainage was an issue. And he had a special type of concrete where it absorbs the water, and then the water goes into tanks underneath, and then it's recycled and then reused as well. So it's some really good green technology throughout this property. So it helped with the claim. But on this, it was a new build. Generally, on new build properties, we find more allowances because everything's fit for purpose, and we don't qualify the land value because it's just the build cost. But on this one, just shy of 600,000, well in excess of £500,000 worth of allowances. A fantastic result, purely because he will be tax-free for the foreseeable. He qualifies for the first year allowance because he's just built it, so which means that he gets all of that relief in the first year and just carries it forward to create a loss. And because it was all brand new expenditure, he also managed to take advantage of the current super deduction, which is at 130%. So then you add an additional 30% on top of what we've already identified for him, and it just bumps it up that much. So it goes up by another like 100k almost. It was really, really good result for this client. So this one, particularly proud of, because it was a really good kind of block, and they've got someone on site. One of the apartments had been converted into an office for someone to be on site 24 hours a day. So that alone qualified this property in its entirety because of everything they had. The security systems throughout the property, it's all managed by a secure lock system. So the tenants aren't allowed to leave unless the person on site allows access to the doors and everything else. So really, really kitted out property, and there was loads of plant there. I was surprised we didn't find more, to be honest with you. But the build cost and the drainage system and all the kind of incidental works that went with all of that, unfortunately, we couldn't qualify. It was just the actual plant machinery that went in that qualified, and all the incidental works didn't. But there's a lot of work that went into the foundation of this property and so on that we had to exclude. But this was a fantastic example of a big block of capital allowances and what kind of allowances we could potentially extract from this type of expenditure, where it's in excess of £1 million.
Amazing. And the super deduction you talk about, is that coming to an end soon, because that's on a limited time, isn't it?
April 2023 is when it comes to an end. So, I mean, the time to take advantage of that is slowly slipping away. They are looking to extend certain things and keep the allowances as they are and all the rest of it, but they will make them, I mean, they've only kind of floated a few things. They haven't actually confirmed exactly what they're going to do. They are looking to bring in a lot more benefits in terms of an additional first year allowance that people can take advantage of. But at this point, it's just in the kind of, where they're just discussing it. So I will provide more information on that and do updates as and when we know exactly what's going on. But for now, that super deduction is still in play, and it is still massively useful for anyone who's doing a brand new development and incurring new expenditure and doing new refurbs to a property. It doesn't qualify for any purchase of existing properties that are already built. So if you buy just a normal kind of old property, it doesn't qualify for that, but it's for all new expenditure. So for new builds, new refurbs, etc., we get an additional 30% on top of whatever you've spent on the property. So it's massive. It really is quite significant.
That's cool. Yeah, that's really interesting to know. Thank you. That's great. It's just good to see some sort of actual practical examples and sort of understand.
Absolutely. Yeah, definitely.
How it can be applied. For people who are looking at this, so obviously we'll drop your contact details into the show notes, Usman, so people can find you if they want to make contact with you. But do you have any tips or advice for people who, who are looking, who have never got into this, didn't understand it prior to this conversation and are looking to learn a bit more about it, or what they should be and shouldn't be doing?
In terms of capital allowances, I mean, the main thing is that we do is add value. I mean, so the main thing is your part ultimately, whereby you're getting these people up to speed on the process of what supported living is, making sure they're hitting all the kind of qualifying criteria that there is for it to be supported living. Ultimately, the only thing we do is once you've come in and you've bought properties, we help you make it more viable by claiming these allowances. So we take all the hard work out of it, and I want to keep it as simple as possible. So literally work with you, get the property up and running, get all the providers in, learn the strategy, get the strategy in play. And then once it's up and running and you're earning money, then give me a shout and then say, right, this is what I've got, this is what we're doing, this is what I'm looking at acquiring. And I'll say, right, and I'll go through the portfolio, I'll do a desktop assessment of every property they have or whatever they're looking at buying. And then they'll have it in black and white as to what potentially they can achieve with all of these properties and what allowances are available. And we do it that way. There's no point giving a generic answer because there is no generic answer. Whatever property you buy, whatever property that person buys, every property has its own benefits and merits, and there's different amounts of allowances, as I mentioned, with regards to the Worthing property and a London property and wherever it might be. So depending on where you buy it. So no cases are ever the same. So we always do a bespoke desktop assessment of every single property based on your circumstances to establish what we can do for you. And it'll be tailored for you as well. So, I mean, the main thing is get the property up and running, earning as much money as possible. And that's when we can come in and add value by helping you retain as much of that money as possible by wiping out the tax bill. And that's what this is all about, just about adding value and allowing you to retain as much of your income as possible from this lucrative property strategy, which is gaining so much momentum at the moment.
Wonderful. Thank you, Usman. Really great to speak to you. Take care.
Take care. See you guys. Bye-bye.
Bye.